Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures pulling back after a record run on Wall Street. All three major indices closing at new highs on Thursday, and the Dow, in particular, closing above 46,000 for the first time. Investors waiting for the latest look at the state of the American consumer when the University of Michigan Sentiment Index comes out later this morning. And all of this coming with just days to go before the Federal Reserve September meeting, where the central bank is likely to cut interest rates by 0.25%. Plus, trade tensions rising between Mexico and China. Mexico is raising tariffs on Chinese-made vehicles to 50%. That's the maximum level. And China not taking it lightly, threatening Mexico to think twice. While the U.S. is not directly involved here, it still matters to the broader trade picture, as the move by Mexico is seen as an effort to placate the White House. Meanwhile, the U.S. will urge its G7 allies to impose tariffs as high as 100% on China and India for their purchases of Russian oil. That's according to a Bloomberg report. And Adobe, one of the top tickers of the day, the software company reporting earnings last night and giving strong guidance for both profit and revenue for the current quarter. Adobe likely seeing a payoff from its investment into AI features. CEO Shantanu Narayan saying annual recurring revenue from AI influenced products topped $5 billion, and the stock is higher ahead of the open. Let's get a check-in on stock futures here this morning. As I said, we saw all three major averages close at a record yesterday, but we're seeing a little bit of drift here this morning after that strong week that we have had thus far and going into the Fed meeting next week. Only NASDAQ futures in the green at the moment, but really all three major averages indicating little change at the open. We'll see how it plays out over the course of the session. Let's dig into our top stories of the day. Markets once again notching records, but they look to be pulling back from those highs this morning. A wave of IPOs that include Gemini and Klarna, and the Fed's interest rate decision, with investors broadly expecting a quarter-point cut after weak jobs data and an inflation print in line with estimates. Joining me now, Yahoo Finance senior reporters Brooke DePalma and Ines Ferré. Brooke, let's start with you at the NASDAQ there, and this sort of backdrop of the strong week and the record closes that we have seen for the major averages.
Yeah, definitely. What we've seen this week is all three major indices crossed to record highs. The Dow even crossing 46,000 for the first time. And really, this has been ongoing momentum that we've seen, especially behind Oracle. And really, this AI tech rally returning and those investors willing to take on some risk in this environment, is largely the market's already baked in that quarter-point cut that's expected to come from the Federal Reserve next week. And I want to dive into some commentary that we're hearing on the street this morning. Ed Yardeni weighing in on his note, saying that there's a 55% probability for his base case scenario. And that base case scenario says that they're sticking with their target of the S&P 500 crossing 6,600 by year-end 2025. He also said that by the end of 2026, it could cross 7,700. He went on to say that there's a 25% probability for a melt-up that lifts the S&P 500 to 7,000 by the end of this year. And he went on to say as well that there's a 20% odds to a correction in the index by the end of this year. But largely what we saw yesterday was really this ongoing rally momentum, especially behind the Mag 7, that was up about more than 1% yesterday.
And Brooke, you know, obviously we're now looking ahead to the Fed. I know you're pouring through all of the notes, trying to see what people are expecting and how that could then affect their outlooks.
Yeah, absolutely. And what we've seen is that markets largely are baking in this probability of that rate cut. And right now, investors are also baking in the probability that we'll see 3 more rate cuts. That's according to the that's right there, the CME FedWatch tool. As you can see there, that quarter-point cut is expected among the street. They're also baking in 3 cuts by the end of the year. And one note as well coming from Brian Rose, he's a senior U.S. economist at UBS, and he even said that their base case remains unchanged, calling for a 25 basis point cut at each of the next 4 meetings for a total of 100 basis points by January. And so really this market is taking into consideration that we are going to see this relief, rates coming down over the next few meetings, something that we haven't seen in quite some time.
Ines, you've been, of course, looking through a lot of the research as well, and you have to wonder, with all of this enthusiasm seemingly in stocks here, what the potential risks are going forward. I believe it's Goldman Sachs that's highlighting potential ones.
Right. Goldman Sachs highlighting two potential risks. They're basically saying that the market is sort of pricing in a resilient U.S. growth, a dovish Fed. That's why you're seeing stocks at all-time highs and bond yields trending lower. But they're saying there are two risks. One is if the labor market turns into a recessionary dynamic, so to speak, that then you could see the markets quickly repricing because the Fed would be pulling forward perhaps some cuts, but that would be putting pressure on equities. So for the next few months, Goldman Sachs is saying it's going to be a period of maximum risk when it comes to the labor market. Then also the second risk being that if growth actually holds up, the markets may be fearing that they perhaps have overpriced Fed rate cuts. So in that case, you could see yields rising, and that wouldn't be as supportive for equities. But Goldman's base case is that you are going to see growth gradually reaccelerating into 2026, and the Fed is going to be cutting into a non-recessionary environment.
Okay, so the risks maybe are low probability, perhaps. One of the other interesting market dynamics we've been seeing is even as stocks have been rallying, so is the thing that people usually get into when they're worried. I'm talking about gold, and as you also watch very closely, what have you noticed there, and what are you hearing in terms of commentary?
Yeah, gold, which has been reaching all-time highs this week, it actually has surpassed the high back from 1980 in inflationary terms. So I'll explain. Back in 1980, gold reached $850. Adjusted for inflation, that would be around 3,600. So gold has surpassed that adjusted for inflation high from 1980. That's significant because that basically is cementing the status of safe haven, of inflationary hedge. You still have central banks that are purchasing gold. You have this trend that has been accelerating over the last couple of years, and it's expected to continue. And you still have the question of Fed independence. And there are some market analysts that have been talking about this sort of moving away from sort of currencies because investors are seeing sort of a debasement of currencies, and that's why they're moving into assets such as gold, such as Bitcoin, and other assets.
Yeah, really interesting stuff. I mean, it's so interesting too. Again, there's no sort of one narrative across asset classes, but one of the other signs of risk appetite here has been the IPO window, which is seemingly opened back up again. Brooke, we've had a number of different IPOs this week, and particularly in, I think, what you can argue are sort of seen as higher beta or higher risk industries. At least at one time they were viewed that way.
Yeah, absolutely, Julie. And there's been no shortment of excitement here at the Nasdaq. If you can see right behind me, Gemini expected to open up and ring the opening bell just shortly. They're setting up their IPO today. Also, later on today, I'll be speaking with BlackRock Coffee Bar CEO. They're set to open IPO today as well. Now, this joins a slew of other companies that we've seen go public in really recent months. That includes Figure, who was just here at the exchange on Thursday. We also have Klarna that's joined to this IPO. Recent announcements: Chime, Circle, eToro, Bullish. And really what we've seen here is these AI, these blockchain companies take to the public market. Of course, BlackRock Coffee Bar is a bit different here, but this will give us a key inside look, similar to what Klarna has shown us, around that consumer-oriented IPO and the appetite that this market that's really been AI heavy and tech heavy will have for these sort of companies as well.
And Ines, something that we talked about with George Martin of Rainmaker Securities, or Greg Martin of Rainmaker Securities yesterday, was how these IPOs have been priced. What can you tell us about that and what you've noticed?
Yeah, so what I've noticed is that the IPOs that we've seen this year have been priced above their range. Most of the ones that have come out have been priced above their range, if not all of them. So you are seeing this sort of pricing above the range, but you're also seeing the pop on that first day. And it appears to be that in the recent ones, the pop has been significant, but not as significant as the ones prior in the season. So I'll just give you an example. Klarna popping 15% on the opening day. Figure also rising 44%. Those are big pops. But when you compare it to Circle, which was up more than 160% on its IPO day, Figma, which was up more than 250%, perhaps this is indicating that the underwriters are starting to price in a bit more accurately, because you want the pop, you want a strong IPO. You obviously don't want the stock to go down on the opening day. But if it goes up too much, then perhaps it's that it's been underpriced. So that's the difference there. And that was what underwriters seem to have been sort of struggling with, because we have been seeing such large pops on those opening days.
Right, so we'll see what the coming IPOs look like in that sense. Brooke, Ines, thank you so much. Appreciate it. Coming up, Adobe's AI efforts are showing signs of paying off. We'll have more on that next in today's Trending Tickers. Now time for some of today's trending tickers. We are watching Adobe, SuperMicro, and RH. First up, Adobe, the design software company providing a strong quarterly revenue outlook. The results easing investor concerns on AI threats and suggest its investments in AI features are paying off. Adobe's work to weave artificial intelligence tools, often based on its own generative models, into the company's industry standard products like Photoshop. Once the longtime leader in creative software, Adobe has faced mounting pressure from startups like Canva and AI native tools like Midjourney. Next up, SuperMicro getting an Nvidia boost after the company announced volume shipments of its Nvidia Blackwell Ultra Solutions. The company emphasized that these solutions are purpose-built and pre-validated before shipping, allowing for faster implementation of high-performance computing infrastructure. And finally, RH, the upscale furniture retailer, cut its revenue forecast for the full year amid mounting impacts from new U.S. tariffs. The tariffs prompting the company to delay its seasonal catalog because it needs more time to finalize its pricing. RH now sees revenue rising 9 to 11% this year, down from the previous expectation for an increase of 10 to 13%. CEO Gary Friedman also told analysts that the industry needs to offer discounts to stay afloat due to the weak housing market. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's Trending Tickers page. U.S. stocks hitting yet another record high, fueled by bets the Federal Reserve will cut interest rates at its September meeting. But has all the good news now been priced in? Joining us now, Troy Gajewski, Future Standard Chief Market Strategist. Troy, good to see you. So how are you thinking about the Fed? And I think it's important to note that not only the Fed next week, but sort of the framework and beyond, right? How are you thinking about how the Fed is approaching this current balance in its dual mandate?
Yeah, great. Happy Friday, first of all.
Happy Friday.
Julie, great to see you. Yeah, so I think there's been a tremendous amount of confusion over the last, call it 2 months, that's coming into much more clarity for the broader investor community. And so much of it is tied to the fact that obviously the implementation of tariffs would lead to shorter term, higher numbers for inflation, but we just don't have the conditions that are necessary or sufficient to set off a significant boom in inflation like we did in 21. We still have a little bit more money supply relative to nominal GDP, but back then we had 28% more money supply that had been created in a very short period of time. You no longer have a consumer that has $2 trillion of excess savings. The savings rates materially lower, the labor market's weakened, and all the excess liquidity that had been sitting in the Fed's reverse repo facility is effectively gone. So there's no reason not to cut because you're fearing another round of sustained inflation. On the flip side, look, the labor market has weakened materially. We've gone from 2 job openings per unemployed person to now 99 job openings for 100 unemployed people, a more balanced labor market. We've seen the substantial NFP revisions that were, quite dramatic and set off quite a kerfuffle, so to speak, in DC. So everything is set for the Fed to cut. We have been thinking 50 to 75 by the end of the year. It wouldn't surprise us if it's 100. And as you look forward, the new terminal rate may be closer to 2 because there's so much pressure on the Fed to bring that front end down. so the Treasury can issue short-dated treasuries in a very high volume to help address the budget deficit situation.
Troy, I'm going to take a step back and attempt to do a little jargon busting / translation, if you will. For people who hear the words money supply at home and picture stacks of bills sitting at the Federal Reserve or the Treasury in DC, we're talking about the flow of money in the economy. Talk to me about what it is, why it's important, and why it is different now than it was, when we were at other times when we have seen inflation go higher.
Yeah, when you and I were far younger, for instance, right? So basically money supply, if you think about it, it was used to be a really big deal back in the 70s when we had a huge inflation surge. And then what happened is the Fed got into this long period and markets got into a long period where money supply grew approximately at the same pace of nominal GDP. So there was no impulse from massive levels of money printing or money contraction to cause a big swing in the economy. So over time, people sort of forgot about it. And then as we went through the global financial crisis and the Fed started doing quantitative easing, they were effectively printing money in a vast scale that you'd never seen before in order to keep us out of a deflationary spiral and finally reach a 2% inflation number, which, as we know, took many, 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 many years.
Yeah.
And then when we went through the pandemic and we had that horrific experience, that was the first tool they turned to, was creating 42% more money than had ever been printed in the history of the country, again, in order to inflate the economy. Now, the problem with that is when you create that amount of money and you have a hyper tight labor market, not only can you drive up financial assets, but you can also spur the inflation surge that we saw. And so what the Fed's been doing, and still is, by the way, shrinking their balance sheet, contracting that supply, but now they're more in equilibrium. There's really no reason to maintain policy in a restrictive stance, which they continue to articulate is where we are today. It's really time to get moving and get more to a neutral stance. And I think the only debate going forward, Julie, on that is going to be, is 2% neutral now, or is it the 3 and 3 1/4 that we thought it was as recently as 3 months ago?
And hopefully we'll start to get some more commentary around that around next week's meeting. What I find so interesting, too, is in anticipation of this move, we have definitely seen risk on come back into the market, right? How is that manifesting in your world, in the world of alts? Are you also seeing that risk on happening? And do you think it sustains through the first cut and the second cut? And does it keep going, or do you see it even pull back once they actually start cutting?
Yeah, so in the alternative world, particularly in private markets, it's having a different but yet similar impact. When we came into this year after the Trump election victory, everyone broadly, I think globally, was really excited about pro-growth reforms, maybe deregulation in the banking system. And what you saw, whether it's in our private corporate credit strategies or commercial real estate lending, or on the private equity side, is there was a huge buildup in expected deal activity. And then, of course, we got Liberation Day and things slowed down dramatically. We'd say starting early August, and now it's been amplified to some extent by expectations of a looser Fed. We've seen a dramatic ramp up in deal activity. And on the corporate side, it can be as simple as just expanding your business. It can be a private to private market transaction or a public to private market transaction. And then on the equity side, a lot of what we've been focused on now are co-investments that have, let's call it high teens expected returns. Not saying we can achieve that. That's the target. And so that's coming back to life. And then on liquid strategies, there are certain ways to play the U.S. mortgage market. I won't bore people with the jargon of what these are called, but when the yield curve steepens and the Fed cuts the front end, that sort of supercharges the income that you're getting related to a prevailing mortgage rate. So it's certainly manifesting itself in a wide variety of areas. Now, in terms of sustainability, again, I'm more with Yardini than I am with Goldman when it comes to a bearish outcome. There are many technical reasons why markets should continue to drift higher. And as long as markets don't experience some unforeseen collapse, we think the private market activity that's picked up so dramatically really since the beginning of August in terms of forward pipeline is going to be sustained for quite some time.
Interesting stuff. Troy, always good to catch up with you. Thank you.
Good to see you, Julie.
Take care. Coming up on Yahoo Finance, opening bid with our executive editor, Brian Sozzi. There he is, joining us now. Soz, what's coming up?
Is Troy sticking around with me? Love seeing Troy, Julie.
You can have him next time.
All right, I appreciate you. Look, we're going to dive into all things Federal Reserve ahead of that meeting next week. What stocks you should look to buy, what stocks you should avoid. And the big chat of the morning, Julie, is with Amazon AWS CEO Matt Garman. Had a fun chat with him about what they're working on AI, and just a really interesting business at a really interesting time.
Looking forward to it, Soz. Thank you. That does it for Morning Brief. Much more ahead on Yahoo Finance.